is a 112 in ES, and I'm going to remove these strikes that I've used before. So the first thing we want to do is, obviously, we have the ticker symbol. We find our targeted expiration cycle, which is 52 DTE. Today, September 19th, 52 DTE is a November 10 contract in ES. So first we find our DTE that we want to target. Why 52? Because I don't think this is a magic holy grail number. I just think that anything beyond 52 DTE is not consistent as far as new contract dates or when they list new SPX expiration. The closer we go in time, meaning if we wanted to find a 14 DTE, there's always a 14 DTE available, and maybe several times a week, right? Because we have now SPX options expire like every single day. So the closer in time we go, the more listings available as far as expiration cycles go. And the farther out in time we go, sometimes we don't have the 52 DTE in SPX like today. And if we go even further out in time, you don't always have, or you don't have a 90 DTE every single week, right? But I did look around, and I think that 52 DTE is fairly consistent. You should be able to find a 52 DTE every week on a Tuesday, except for today and a few other times. But for the most part, 52 DTE in SPX is available every single week on Tuesday. So that's why 52. Is 45 better than 52? No. Is 52 better than 45? No. Right? So whatever you're going to do, you just have to be consistent in order to analyze your results and understand if it's worth continuing doing what you're already doing, or you need to tweak something out. Right? I always say that consistent input is going to be equal to consistent outcome. Whether it's positive or negative, we don't know, but you have to have consistent input in order to look for consistent output. And if your output is negative and consistent, then something needs to be changed. So 52 DTE, and we also did some back testing, and we ran a 52 DTE or close to it, and it's fairly consistent as far as results go. So that's why 52. So the first thing I do with a 52 DTE is I look for a 50-point wide put debit spread. And a put debit spread that I look for, I usually look for something that is going for somewhere about maybe $10 to $12 debit. Now the next question is, why 50? Why not 60? It doesn't matter, right? If it's a 60-point wide put debit spread, you're going to pay a little bit more, which means you're going to need to sell something for a little bit more in order to cover the cost, which means that if you're selling something to cover the cost of your put debit spread for more, it's going to have to be a little bit closer to at the money, which means you're probably going to take on a little bit more risk, directional risk, which means that that could work, but it'll probably work better if your near-term market outlook is bullish. So the difference between a 50 wide or a 60 wide or a 100 wide, I know Tom just recently introduced a new idea, right, of a really fat bear trap, which is a really, in my opinion, powerful trade idea. Could you apply it in any market? You can, right? You just may need to do a little more tweaking if the market starts to move after you put the trade on. But, you know, you can set up this trade in any way you want as long as it aligns with your near-term market outlook. So if you're bullish, you could take on a little bit more directional risk, which means that the trade will start off with a little more positive delta. And that means you can place your naked puts closer to at the money. Now, if your market outlook is bearish and you want to go out as far out of the money on the naked puts as possible. That means you're going to bring in a lot less credit up front, which means you can't spend too much of that credit on your put debit spread. So either your put debit spread has to be narrower, right? You want to pay less money for it, or it has to be further out of the money. So here we are looking at a 50-point wide. I like to keep them at 50 points unless I have a really strong directional market outlook. And most of the time I don't, unless we're, down, I don't know, 7% or 10% in like 2 weeks, which kind of gives me a very strong directional bias. But right now, if we just look at the chart, right, we have to assume that, we're still making higher highs and higher lows, except for now we have a small warning here at around 45.50 on ES. We could not go up to as high as previous high. Could this be a first lower high? And this could potentially signal that this trend that we're seeing since this is going back to March, and even before then, this is October of last year. So we've seen a pretty strong up move so far, and now we're making a lower high, which could potentially signal that this trend is starting to change. Until we take out, this would be 43.50, right? We don't know yet. But to me, there's nothing bearish. I don't think the sky is falling. I think the market may be a little tired, so maybe we'll spend some time just going sideways. Maybe we do come back and retest previous resistance, which could potentially be a new support somewhere around 42.50. But these are a lot of assumptions. We don't know that, right? So we kind of have to play the hand that we're being dealt right now. There's nothing bearish, so I wouldn't go too bearish, but I would not go too bullish either. So I would try to keep, as little directional exposure as possible, at least when I first put the trade on. So to me, I think that there's nothing extremely bullish or extremely bearish just yet. So my standard 112 is 50 wide. So I'm looking for a 50-point wide put debit spread, and I want to pay somewhere between $10 and $12 for it. So it just works out that 43.75, 43.25 put debit spread in ES is currently going for about $11.50, which is good enough for my purposes, right? That's my put debit spread. It's about 4% out of the money, which is not terrible. Again, if we look at where do I enter the trap? Right, this is my break even somewhere around 43.60. And if we go back and look at the chart, where's 43.60? So if we are going to, in fact, take out the previous higher low, and the market's going to continue to roll, this is where we enter the body of the bear trap. So looking at this chart here, if we stay above the 43.50, we're not going to enter into the bear trap. This is where that bear trap profit comes from, which means that if we're not going to go below my downside break even, we're not going to enter the body of this trap, and we're going to be somewhere above. I need to cover the cost of this put debit spread, which I'm probably going to end up paying about $11.50 for, which means that I need to go out and I'm going to sell 2 out of the money puts. I'm going to look for a put somewhere around $11, $12. So let's see what that looks like. I'm going to go and find a put for, let's see, the 4,000 puts are going for about $11. So let's see if we sell 2 of those. What is that going to look like? That's not terrible, right? So this is one contract. We are buying to open 43.75. We are selling to open 43.25. And then we're selling 2 to open at 4,000 strikes. Net credit, $11. Now keep in mind, if you're trading ES options, right, they have a multiplier at 50, which means that we are not collecting $1,100 for this. We're only collecting about $550, right? So in order for us to collect the same amount of dollars, right, if we did the same exact trade in SPX, we would be collecting close to $1,100 per one tranche or one contract. But since we're looking at ES options has multiplier 50 instead of 100. We would have to double the size of this trade, which would be 2, 2, 4, or a 1, 1, 2 times 2. We'd have to do 2 contracts in order to collect the same amount of dollars as far as credit goes up front, right? But the idea here is we spent $11 to buy the put debit spread, and then we sold 2 puts for around $11. So what happens is the first put that we're selling goes to cover the cost of this put debit spread, and the second put that we're selling is going to give us that 1,100 or 11 points of credit up front. Now from here we have a couple of potential outcomes. Outcome number 1, as we talked about, if we don't take out at 43.50, the market kind of comes down to maybe 4,400, makes another higher low, and then continues to trade higher. We only get to keep whatever we collect up front. And in a very strong uptrending market, that is the most common scenario, is that the price kind of drifts higher but never really comes down into the body of this trade. So we get to just to keep, whatever we collect up front. In a strong uptrending market, you're most likely to make the upfront credit and never get the bear trap profit. Last year, market was a lot more mean reverting. We've seen pretty decent moves up and down in a very short period of time, and there were a number of trades that ended up inside the trap, right? So we initiated a trade, maybe it was 50 or maybe 60 days out, and the market went up and went down and went up and went down, and by the time expiration rolled around, the price was inside the trap. And it also helped the fact that implied volatility was higher than it is today, right? Last year, implied volatility was higher in relative terms. And when volatility is higher, when we enter the trade, because there's more premiums available, we get to place this trade with the body being much further out of the money. Well, I shouldn't say much further, but right now with the VIX where it is, right? If you look at implied volatility for 52 DTE, IV is at about 15.5%. Now, if we look at an entry point where you have implied volatility for 52 DTE, somewhere close to 20, your naked puts are not going to be about 11% out of the money. They're probably going to be closer to maybe 15 or 16% over 52 days. So, and it's pretty obvious that the risk is putting on a ton of these trades when IV is relatively low has the risk of potentially getting into trouble if the market starts to move around a lot more, and the value of the short puts is going to increase drastically. So you definitely want to set up trades like this when implied volatility is higher in relative terms. But if you're going to sit around and just wait for the VIX to cross 20 before you put this trade on, there's only going to be, in the strong markets like we're seeing this year, you're going to sit around for the most times, and you'll have maybe 2 trades a year, which is not really ideal, right? So you kind of have to put on trades often enough, right, to be involved, to manage your risk, and the outcome is going to depend mostly on how well you play your hand, right? How well you're able to defend your position, and the outcome is going to depend on 2 things: how well you play your position, and how much lucky you're going to get as far as how far the price is going to push inside of the body of this trade, and how soon or late in the trade that happens. The sooner or the earlier on this happens, the less advantageous this is for us, as we can see that, our T+0 line is really pointing downwards. So if this happens, in 3 or 5 days after entry, if we get a 5% down move in a couple of days, yes, we are moving inside the trap, is where we want the market to go, but it's way too early. There's way too much time left, and this trade is going to show a drawdown, right, which is going to be not pleasant to sit through, but it doesn't mean that it's a bad trade, or it doesn't mean that you need to run for cover just yet. But if we look at the same, but much later, let's say if we look at this trade with just a couple of maybe a week to go, right? If we're inside the trap, say the market pushed down inside the trap, so somewhere around 42.50, with only 8 days to go, you can see that T+0 line is much better looking than if this was to happen, maybe 7 days after we took the trade. So at 7 DIT, right, days in the trade, this would be a drawdown of about $1,200. And if we look at the same trade with 8 days until expiration at 42.50, this trade would be a positive plus $2,500 P&L. So big difference if that happens in the first week or if it happens with 1 week to go. So while we do want a push lower, we would rather see it much later in the trade with less time until expiration. So the initial risk is much greater than later on in the trade. And the more days that go by, the smoother or the better this T+0 line is going to look like. And if we can look at some projected T+0 lines, right? So we get to compare our T+0 line at different points in time, not just price, but also different points in time. So for example, the green line here is 52 DTE, right? So if the market pushes down, that's not going to be nice. If we look at the red line here, this is T+13. So this is October 2nd, 13 days from today. So if we see the same push lower, our P&L isn't going to be as drastic, if you will. It's going to be a little bit better, but it's still going to be a drawdown, right? We're going to be in the negative, but probably less than if this was to happen today. And if we look at this gray line here, this is T+26. So this is 26 days from today. The same move down to 42.50, we would actually possibly show a profit, right? So if this happened today, loss of about 2,000. If it happened a week, or the red line is 13 days, so 2 weeks from today, same move down to about 42.50, losses somewhere around maybe $800. So we went from down 2,000 to down 800. And if the same push down to 42.50 happened in 26 days, this trade could actually be still profitable because there's less time until expiration. More time has gone by, which means that the short naked puts have decayed enough to show a net profit in this trade. So let me just fix this. All right, so the outcomes. If the market goes higher, we get to keep credit we collect up front. If the market pushes lower, early on, we run into trouble. Later on, it's actually the benefit for us. We have put debit spread that's going to increase in value, and the naked puts that are out of the money are going to lose value. So we'll have two things working for us. Put debit spread increasing in value, we're long, so that's working for us. Naked out of the money puts are short, and as time goes, they're going to lose more and more value. Since we're short and the value of these puts is dropping, it's also working for us, so we get the benefit, and that's what we want to see. We want to see a move lower, but slow and over many days. Not today, not next week, not in 2 weeks. We want it in 4 weeks. So move down is welcome, but not near term, longer term. And then scenario number 3 is the market makes a swift move to the downside. And that's where we all need to know, right? What do we do? Now, there are several ways to manage something like this. You could possibly take profits on your put debit spreads and consider rolling the short naked puts. And that will, put you in a commitment to roll until eventually you'll come out of this trade. That works. Is this good or bad? Neither or both. Depends on what you want to do and how much time and energy you want to spend on it. Or you can just say, all right, I'm going to set a dollar amount. If I'm down X, I'm out, and that's the end of it. So let's say for this trade, right, and I'm just using the numbers that I'm seeing in front of me here. What's my max potential reward inside the trap? That's my best case scenario here, right? I could make $3,000 if we get a push lower and we expire inside the trap, make $3,000 in this trade. So if I'm down about $3,000 in this trade, that's my stop. Is 3,000 or 1x bear trap profit the golden number or the holy grail number? No. You want to say, all right, I want to be more aggressive. Maybe I'll trade a smaller size, but I'll give it more room, and I'll go 2x bear trap profit. So when this trade is down 6,000, that's your stop. That works too, right? Again, you have to apply what we're talking about here to your individual situation, to your individual risk profile, to your trading style, right? Some people put on more size that they can handle, and as soon as the market starts to move lower, you barely start to scratch the trap, and you're down $500. You say, oh no, I can't take that kind of loss, and this trade was never for you. But you have to understand that before you take the trade. Or someone says, yeah, I'll take a 1x bear trap risk, okay, and then the trade is down 3,000 at 4,200, right? We're down about 3K in this trade, and that same individual will say, oh wow, I can't take this kind of loss. And now, right, they're committed to doing things they did not plan for or don't want to do. So all of that stuff needs to be thought about and planned before you take the trade. So in this example, if I was to put this on right now, what I'm looking at is I'm collecting about between $500 and $550 up front. I know my best case scenario, if in 52 days we're somewhere between 43.25 and 4,000, this trade could make $3,000. But if I'm down 3K at any point in time in this trade, I'm out. So today, if the market was to fall through 4,200, I'm going to have to stop out because I'm going to exceed my dollar limit, right? If that happens, let's just say 30 days from today, where's the point where I'm down 3K in this trade? All right, we'll look here. This is 3,000. I'm going to go all the way down to about 40.50, right? So as time goes, my stop loss or my stop out price level is going to be pushed further and further away from today's price. But that number doesn't really change, right? If we are looking at 30 days into the future, if I'm not down 3,000, I'm still in this trade. I don't have to look at it. I don't have to, sit there and babysit this trade. I know that if at any given time, if I'm down $3,000 in this trade, that is my signal to get out. And to answer your question, do I stop out manually? Yes. So number one is I don't think that Tastytrade would allow any stop loss, or especially with the 112. There's no way to enter this trade into Tastytrade as one order. So for those that are trading using Tastytrade, you would have to manually unwind this trade. And number two, I also don't want to set stops in Thinkorswim, because when things starts to move a little bit too much, right, when the market gets a little excited, bid and ask spread starts to widen, and I don't want to run the chance of my stop getting tripped. My order becomes a market order, and then I get filled at the worst possible. I would be handing over my trade into the hands of the market makers and say, here, do what you want with it. And do you think I'm not saying they're, market makers are bad or evil people. I'm just saying, do you think if you hand over the order to the markets and say, here, fill me at whatever is available when the market is really excited and we're down maybe 2 or 3 standard deviations on that day, I could almost assure you that you're going to get a fill that is not favorable to you. So I wouldn't want to do that. Instead, right, you look at your trade, or if you use any kind of software that will tell you around what price level you should consider getting out of the trade, just like I'm doing right now, right? Let's say we go into tomorrow. Let's say this trade is already on. Where's my stop? Where's my minus 3,000? Here, right? 41.95. So let's round this off to 4,200. I know that if tomorrow market goes to 4,200, this trade is done, right? Because we could account for a little bit of an increase in implied volatility. So I think that if we were really to move down 6% tomorrow, volatility would be much higher than it is today. And I would probably reach my minus 3,000 stop level higher than what this software is projecting. So I know that, if I think there's a chance, or if I'm not going to be around to watch this, I can just put a price alert on my, Thinkorswim or whatever you may be using, and say, if the market gets to 42.50, can you please send me an alert and wake me up? And I know that I need to go and do something, right? This isn't just to kind of let me know and I'll hit the snooze. You can't. So you put your alert at 42.50, for example, right? And if we get there, you need to go and you need to check on your trade. If you're not down 3,000, if that was your stop, then you do nothing. If you're down close to it, if you're down 2,800 and the market is nasty, I can just tell you right now that it's as good as stopping out, because, odds of the following day market going back up and, you're saying, oof, almost got stopped out. Thank God I didn't do anything. But what happens if the market goes down another 2 standard deviations to the downside the following day? You were, down within a couple of $100 of getting your stop loss hit. You might as well take it off to avoid the chance of the next day having to take a much larger loss than you would have otherwise. Right. So that's just something to think about. I mean, I don't like, the black and white rules. This, you do A when B and you do C when Z, no, but, you need to apply this, human element. Like you need to look at your trades and you need to understand how and what you're going to do if, whatever happens. So I hope this helps, for you to kind of, get inside my head and understand the thought process of not just setting up the trade. How do you look at potential outcomes? What are you going to do if this? What are you going to do if that? Right? And we're going to talk about this more and more and more. And I think at some point I'm going to beat this into your heads for you to able to, think about this process the same way, or, something along the same lines. And I think it's going to help you guys overall and in the long run to become better risk managers. So a question, do I consider IV percent increase at T+1? I don't. Again, volatility matters more when there's a lot of time on the clock, right? Because the more time we have until expiration, the more uncertainty there is, right? A lot more can happen. So if, and you can see this, right? If we were to compare, T+0 today, or T+0, this gold line here with only 13 days to go, the more time that is run off the clock, the less volatility matters and the more price movement starts to matter. Because if we're at 42.50 with 13 days to go, right, what are the odds of the market going down another 250 points over 13 days? It all depends, right? How, what has happened in maybe 2 weeks prior to that. But if the market has been just kind of slow and, nothing too exciting going on, even if we get to 42.50 over the next 39 days, right? If we get to 42.50 over 39 days, that's kind of slow, right? We could consider that being pretty slow. I mean, another way to look at this, would be maybe looking at the chart. We can't see that on Option Explorer until we commit to this trade. But once we do commit, we would see a standard deviation cones, right? One standard and a two standard deviation cone. And I would be interested to see what is the market pricing in a move. Oh, actually, we can see that here. We are looking at, what did I say? T plus 39. So T plus 39, we have T plus 38. So T plus 38, if we moved down to 42.50 in 39 days, we'll be just slightly outside of what is currently being priced in. So I don't think the market would be in panic mode. I don't think implied volatility would be at 30. I don't even think implied volatility would be at 20. I think we would still be relatively within the normal, right? Whatever that normal is. I think VIX at 18 is pretty normal. VIX at 15 is historically not very normal. So to answer your question, I wouldn't, especially with very little time until the end of the trade, I wouldn't worry about volatility as much. And with 1 day, I wouldn't put too much weight on volatility in 1 day, only because 1 day doesn't, make or break the market. If we're seeing, outside of one standard deviation moves a couple of days in a row, I think volatility increase is going to matter a little bit more, but you always have to think that, or you have to assume that implied volatility is going to mean revert, right? We're going to go back to normal or back within the range, right? We're not going to move 3 standard deviations for the next 2 months every single day. So you have to assume that volatility may expand a little and then it's going to contract eventually. So I think volatility really doesn't matter as much as price does. I think this trade could run into trouble. Sure, an increase in implied volatility is going to cause a bigger drawdown in your P&L early on in the trade for sure. But I think the price, right, if we have to assume that implied volatility is going to mean revert at some point, we don't have to worry about it as much. It would be a lot worse to think that price is going to mean revert and watch the price go way beyond your short naked puts, assuming that it's going to be all right. I crossed my fingers. It has to come back. It's all, you can't think that way. So price risk is a lot more important than implied volatility risk. All right. So this is the idea for ES options, how to set up a 1-1-2. We can model this trade, and I can tell you what it's going to take as far as buying power goes in Tasty Trade. And if you guys are setting it up in other brokers, interactive brokers, Fidelity, I know some people use, and if you want to chime in and share what is the buying power effect for one contract, just to compare, because this question does come up from time to time. And, I think that, look, if you're using a broker that isn't giving you a decent, I don't want to say leverage, but if they take up a ton of margin, even with ES options, and that's what you want to trade, I'm not saying you need to close accounts and, destroy relationships you might have with your existing brokers, but, this industry has become extremely competitive in the last couple of years that you need to go where your money gets treated best. So let's have a look. 43.75 is the long leg, right? We're buying 43.75, selling 43.25. That's currently going for about 11.50 debit on the Tasty Trade. And then we are selling 2 of the 4,000 puts. And I am seeing a net credit of about 11 credit, and I see a buying power effect of about 9,600. So Tasty Trade will take up $9,600 to put one of these on. Do not size this trade based on the buying power effect, right? Like if you have a $100,000 account and it only takes about 10 grand to put this on, say, oh, I can do 10 contracts. Nope. Because if, going back to what we just talked about, if let's say, I'm not saying that this is what everyone should use, but if your stop loss is minus 3K and you put on 10 contracts because that's how many you can fit into your account with very little buying power effect, right, from your broker to put this trade on. If you put 10 of these on, because that's how much you can fit into your account, and you're forced to take a loss of $3,000 per one contract, and you have 10 of these, that's a $30,000 drawdown. If you only have a $100,000 account, you just took a 30% haircut. Now, how much do you need to make just to get to break even? You're putting yourself in a very tough situation. So do not size your trades based on buying power requirement. Look at your worst case scenario. If I have a $100,000 account and this trade has the worst potential outcome of me losing 3K, what's that, a 3% drawdown or 3% of my net account value? That's reasonable, in my opinion. If it's too much for you, then that's too much for you. You don't have to do it. But it's much easier to take a $3,000 loss than take a 30% haircut in your account because you took on too much size and you used the wrong metric to size your trades. So don't size your trades based on buying power requirement. Size your trades based on the worst potential outcome. And one last thing, do not size your trades based on initial credit, right? For somebody with a $100,000 account saying, what am I going to make here? $500? Man, I don't want to make $500. I want to make $50,000, which means I need to take many multiples, right, of this trade. And once again, you put yourself in the position, if you were put in a spot where you have to take a loss and you took on way too many contracts because you looked at, right, what am I going to make here? It sounded like it's too little. I needed to bump up the number of contracts to make, a lot more than what you stand to make with one contract. Again, you're using the wrong metric to size your trades. Size your trades based on your stops. If you're forced to close this trade at a minus 3,000, figure out how many dollars you're willing to risk in this trade, and then you divide that by 3,000, and that'll tell you how many contracts. Let's say you said, you know what, I'm going to risk 6% of my $100,000 account. You take 6,000 divided by 3,000, that put you at 2x, or 2 contracts. Maybe you're willing to go with a little more than 2 contracts, but then you know that your stop loss is going to be a lot closer. You don't give the market enough room. You can do that if you think the market's about to turn bullish. So there are many ways to kind of do this. You have to use common sense, and you have to do and size your trades according to your account size, according to your risk profile, and according to your near-term market outlook. I hope this was helpful for you guys. Let's spend next couple of minutes if you have some questions and I can answer, that would be awesome. Otherwise, we're going to wrap this up and I'm going to have you guys on your way. So this is one question that comes up a lot, right? People worried about market down 10% in a day. I know that it's normal to think about, these black swan events. Does the market go down 10% overnight out of nowhere? I think there are signs that may be leading up to it. I don't think there's any kind of clear sign that, hey, tomorrow the market's going to be down 10%. But the market usually tends to get heavy. There's headlines. There are things that may kind of hint that the market is getting weaker and you need to really worry about it. But let's just look at this question for what it is. What if the market is down 10% in a day and the stop might not work in that case? I think that, and I know where this question possibly could lead to, well, how do I hedge this? I think the answer is, I wouldn't spend too much time thinking about how to hedge this one position. You may want to think about hedges from your portfolio standpoint, right? You want to understand how much exposure you have to the market and what happens if the market is down 5%, what if it's down 7, 10, or more percent. We also don't know the exact answer because we don't know how volatility is going to change. But we have to assume that, if the market starts to, head lower, you are, in this example, especially, you're using ES options, which trade around the clock, right? You should be able to get out of your trade since the market is open around the clock. And number two, right, this is another, I think, more important than, if you cannot get filled, right, on these ES options, because they're not the most liquid. Guys, whoever's doing this soundboard, like if you're bored, go do something else. So if there is no liquidity to get out of your options overnight, I think that another way to do it is you're using ES options, which will tell you about your directional exposure to ES. And what you can do is you can use MES, or you can use ES contracts, future contracts. They also trade around the clock, and they're very liquid. So you can hedge off your risk that way. So for example, in this trade here, for one contract of this ES, you have about a 4 delta exposure to the ES contract, right? So we know that one ES contract is a 50 delta. So you can't really hedge off 4 delta. But now we know that MES, the micro E-mini contract, is not a 50 delta, it's a 5 delta. So let's just say the market starts to move and I'm up at night worried about this. My net delta here, and if the market is pushing lower, you can see that on the way down, your net delta is going to increase. So if we say get down to about 4,400, my delta in this trade, assuming we'll bump volatility just a little bit, right? So at 4,400, my delta is plus 10. What do? I can't get out of this position. Well, I can just short 2 MES contracts, right? Each MES contract is a 5 delta contract. And this is not an option. This is a futures contract. If I short 2 MES contracts, my net delta between my short future contract and my 112 position in /ES is going to have 0 market exposure. Something along those lines. So, right, we're using futures overnight to hedge off our positions until we get liquidity that we need in order to unwind our position. So there's no way to completely escape this, unharmed. Sure, there's going to be some slippage. Sure, there's going to be some losses, but using futures that trade around the clock and very liquid, you can avoid this tail risk that everybody always is worried about. And the reason I said I wouldn't spend too much time thinking about how to hedge this one individual position, because that risk, that 10% down move overnight is always going to be in the back of your head. So you have to think to yourself, and again, I don't think there's right and wrong, but if you're collecting $500 in this one lot, right, how much of it are you going to spend to hedge this position? If you're constantly worried about a 10% down move and you spend your $500 to hedge this position and the hedges don't really work out after 5 or 6 months, if you're in a bullish market, let's say you're putting these trades on for 5-6 months, but you're not making anything on the upside because you keep spending your upfront credit to hedge this position, and you're just kind of spinning your wheels and you're not really getting anywhere. So it's okay to think about the risk, but you have to be able to delta hedge off your risk if a 10% move happens overnight, rather than putting on this trade and then adding a hedge on top of this trade, because you could end up spending more on the hedge than you will make in the long run. All right. Well, I think this will do it for now. We'll continue to have this conversation, and I think that all questions are great questions. So don't hold back thinking that, your questions are stupid, and they're not. I think that others may have the same questions, and if you ask and somebody else didn't for the same reason, eventually we'll answer most, if not all, questions, and this will become a much clearer process. So with that being said, I want to thank everybody for taking the time to listen to my rambling, and if you have any other questions, you can put them in the we have the 11X Bear Trap channel. There's also a forum where you can start a topic, especially on something that comes up time and time again. I think this is great and a better way to manage information, rather than just ask something in the chat and then have that question get run over and then not being able to find it. So I would encourage you guys to, if you have a question that is that may come up at some point in the future, or if you think that it's a question that isn't related to what is happening today, for example, right? If somebody wants to say, hey, do you guys know why the market is down? I wouldn't go to a forum and start a topic on that, right? But if someone says something like, what's one way to delta hedge my position using MES contracts, or something like that, right? So this is not something that is related to you individually, because others may have the same question, and it's not something that is about what's happening in the market today that is going to be irrelevant a couple of weeks from now. So if you have a relevant topic to discuss, I would encourage you guys to put this in a forum, right? We have Income Navigator forum, and I think that we can get value from that over time, and others can come back and look at different topics. And instead of going into the chat, asking a question, and then having the same question asked time and time again, over time we'll build enough topics in the forum, and I think it's going to help everybody going forward. All right, I'm out on time. I'm going to talk to you guys later. Bye-bye.